Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 15th of June. I'm Daniel Lam, your host for the podcast. As expected, the Fed kept interest rate unchanged. But the big surprise here was that the Fed funds rate projection for year-end rose to 5.6% from 5.1%, i.e. it is implying an additional 50 bips rate hike this year. Now, Powell indicated that no decision has been made about the future yet, but he did highlight that the July meeting is quote-unquote live. Powell underscored that economic data released since March suggests that more restraint is necessary than policymakers had anticipated 3 months ago. On this front, the cumulative tightening, the lag effect of monetary policy on the economy and inflation, and economic and financial developments will guide the Fed's assessment of the extent of further tightening needed to bring inflation back down to the 2% target. Market participants assigned a 60% chance of hike in July, up from 10% just a month ago. Incoming inflation data will ultimately guide the policy path over the coming months. Asset class reactions were mixed, initially weaker for equities, but recovered somewhat towards the end. US 10-year yield has been testing resistance though, and may probably break out on the upside and challenge the 4.1% level to reflect possibly higher yields. Now, what that means for you, the investors. This more hawkish Fed may start to induce some investors to think about their quote-unquote comfort zone in US equities. Now, growth data is still better than expectations, but the tightening Fed may start to provide the catalyst to bring this data down. This may induce investors to start slowly booking some profits in US equities and rotate into other regions. Now, Chinese equities is looking interesting, like we highlighted in the last few podcasts. And the reaction of Chinese stocks overnight has been positive, closing near the highs. And a confirmed visit by Blinken to China may provide the necessary thaw between the US and China for investors to return to Chinese equities, at least for the short term, say for a 3-month horizon. Chinese equities are trading at 30% PE discount versus global equities. And if you compare that to the 15-year average, it is at more than -1 standard deviation discount. It is cheap. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.